welcome back to another episode of the Lender Podcast. Today, I am super excited for this episode because we have jjbuckner, and for those who don't know, we've got a long history of businesses. And when he told me that he was doing some hard money lending, I almost booked a ticket and flew out there and could kiss him because I was like, "You're kidding? What? No way! This is happening!" So this will be good, and I think it'll be a little bit more engaging and interactive than our typical podcast, just because JJ and I have so much history together, and he's a good friend of mine. So JJ, thanks for being here, buddy.
Yeah, man. Thanks for having me. I'm excited to talk about it because, like you said, you and John, I'm sure John will hear this one, are the two main reasons why I got into this. Mm-hmm. So I'm excited to be able to kind of really hone in on some of these questions that I've had since I started. And I think it's really going to be beneficial for whoever's listening and is thinking about getting started, or maybe has a couple under their belt. There's a lot of stuff in here that I went through, and I was like, if I can just, instead of having to call Bryce, but hey, what do you think about this, man? Be able to sit down and
all in a podcast episode.
Oh, it's going to be so nice.
Yeah, agreed. No, so kind of the context behind this was when I heard JJ was starting to do some lending, I figured it would be really beneficial to do almost like a reverse podcast, in the sense that JJ's just getting started. Like let's have him come up with a list of questions and almost interview me and see like how we do things. And that's not to say that, our way is like necessarily the right way or the perfect way or whatever it is, but regardless, I think if you're just getting started with lending, I think it could be mutually beneficial. So let's do some let's do some context, some background. Let's just so the audience and listeners can kind of hear like how did we first meet? How did we get involved? Like what's kind of our backstory? Because we've been good friends for I don't even know, 5-6 years now, whatever it is. But
yeah, it's like 5 or 6 years.
Yeah, and like just internet friends. It's kind of the craziest story. Like in this day and age, you would not think that you would have good buddies that live, halfway across the country, but it happens. So
Lindsay, my wife, always makes fun of me because she's like, literally your best friends are all from the internet. I was like, I don't know if that's a good thing or a bad thing, but it's the truth, man.
Like the nerdy kids in high school who have like, they're so freaking weird that they have their like little like niche club, and you have to be so eccentric, like yes. Magic the Gathering, or like playing marbles or something, like in the courtyard, like that's it. Like you find your tribe over the internet, and you just cling to those people.
It is. Well, I'll say this though, man. The coolest part is like the best part about the internet is that you get to surround yourself with people that are doing the same things and want the same things in life. Because when you're living in your town, like you have your good friends, your good buddies, but everyone's kind of going in their own directions. They have their own goals, aspirations, and stuff. But like, to be lucky enough to have met you and the other people we've met and surrounded ourselves with in the space, and to see where we all were at, 5-6 years ago to where we are now. And when you really take the time and look back at that, you're like, holy shit, man. Like every one of us went in a little bit different directions, did different things, but it's so amazing to see that like core friendship group we had 5-6 years ago, and to see how everyone's blossomed. And their businesses are rocketing, and they're, people are traveling the world. You got guys running 100-mile races. Me and you were able to start a successful business together. Like, it's so cool to be able to go back and see kind of where we all started to where we are now.
Absolutely. I love it. Yeah. And you're right. Like it's weird that like, so again, just a little more context. Like JJ and I, we met initially over YouTube. So JJ is still very active in the YouTube space. I'm more or less in there, but originally we were in kind of a mastermind group. We would get on a call once a week and just talk strategy and how to improve our videos and tweak videos. And then eventually that kind of blossomed into meeting in person. We went to a couple different conferences, and then we stayed in touch. And
we went to eventually, Indian.
Like JJ said, oh yeah, we got some bomb
tore
Indian
up some food. Indian food. Well, no, dude, it was funny. What happened? I remember it to clear as day. I was walking, I was actually leaving to go get lunch, and then I saw you and I recognized you, and I was like, hey, Bryce, what's up, man? And like the first few seconds when you meet someone from that you've either met or you've talked to or you've been talking to on the internet, it's a different feeling because you're not really sure how they're going to react or how they're going to take it, or are they the real person they are online. Mm-hmm. And I will say this: the worst part is when you meet somebody and they're a completely different person than what you thought they were, and it happens all the time. But the best part is when you meet somebody and they're like, "Holy shit, this guy's legit. He's exactly how he portrays himself to be."
Yeah, yeah.
So then I was like, "Hey, you want to go grab some Indian food? I'm about to go get lunch." And you're waiting in line for something. You're like, "Screw it, let's go." And then the rest is history, dude. Now look at us.
Well, and dude, I could say the exact same thing about you. Like there is that just weird like moment when you're like trying to kind of feel out the situation, like, and it's like, if in this day and age when you can post stories and stuff, people like pretty intimately know your life. I guess depending on how much you post. But like, I was like, I felt like I knew you. I knew like your kids. I knew like kind of your backstory and stuff. And like, it was just weird to realize like, oh, this dude is like he's authentic. He's legit, and like he's exactly like I imagined him to be. So yeah, like you said, that we went and got some Indian food and just talked shop, and kind of the rest is history from there. So
yeah. And then we stayed in touch, and fast forward, what was it? Probably 2 years later, I called you out of the blue. I was on vacation in Hawaii, and my mind's supposed to be at ease. Idea. And as a typical guy who can't keep his mind shut off, my gears are just running, and while I'm on vacation, because I'm sitting there, I have nothing to do. And you and I are kind of the same way. Like we like to stay busy and always have, working on something. And because you said something the other day I saw on your stories or something like that. It's like you truly love what you do. And like I'm reading this book right now. It's called The 38 Letters. Like, it's like John D. Rockefeller's 38 Letters to his son or something like that. The last letter I just read was one to his son, talking about how comparing enjoying your work versus not enjoying your work, and comparing that to heaven and hell. And it's so true how he kind of plays it all out and explains everything. But it's just like, if you really wake up and you can find something in your life that you're truly passionate about and that you want to do and work towards, your life is completely different. Because I remember I've been in both scenarios. I've been in a job that I hate. I looked at it as just a regular, job, making the money and pay bills. And now what I'm doing now is something that I truly am passionate about and I love. Your life is just so, the happiness and kind of like the meaning of life is so much better. And obviously I think the first thing is love, but once you get that settled in family or friends or whatever around you, then you find what you can actually truly love to do. It's the best of both worlds, man.
Oh, yeah. Dude, I remember like even just this week, I was talking to my wife and we were talking about like, I don't even care what day of the week it is. Like the whole week to me just like blends together, because like, I was like, is it Tuesday? I legit have no idea, because every day is the same, because I fucking love what I do. Seriously. Like it's amazing.
It's Saturday at 12 o'clock and you and I are texting each other. We're like, hey, you want to hop on do this podcast? We're like, yeah, sure. Let's do it.
Well, and like you have that lifestyle, you have that freedom. Like you went to breakfast today with your family, and then like, I'm sure you got plans after this, and we've got family coming over later, but like, it doesn't matter. And I'm going to be like working on the business later today too. Like it does not matter, but also I can go golfing on a random Tuesday in the middle of the week if I want. Like it doesn't matter, because I fucking love what I do. And I'm so glad that you're there, because like you said, I have been in jobs before that I hated, I despised. And like 5 o'clock would hit and I would be walking out of the office, and like this like existential dread just started at like 5:01. And I'm like, okay, I really got to live up this weekend, because I cannot, like, I'm counting down the minutes until I have to go back to the office, and I just don't want to do it.
Yeah.
And that's long gone. And I'm so glad that we're both there. Like finally, it's like,
me too.
Yeah.
Me too, man. And it really does feel great. And I want to circle back on something that I kind of got took a tangent there when I was talking about being in Hawaii, and I called you because I had my gears rolling, and for the business, I'm like, hey, Bryce, I got this idea, man. First, how much would you charge me to make this? And you're like, oh, well, let me think about it. Blah, blah, blah. And I remember you're like, JJ, you're probably not going to be able to afford me to do something like that. Thank God you said that, because I would have broke the bank the first weekend probably.
Oh yeah, dude. And I told you that. I was like, we're going to have to partner on this. Otherwise you're going to go bankrupt. Like, like just the initial concept was like 2,000 hours. And as you know, like it was a multi-year long project. And like, my goodness, like it's been crazy. So yeah. Thank goodness that didn't happen.
I know, but no, dude, like, I'll be honest with you, man. Like, and I know we've said this before, but how cool was it to be able to grow something like that? I mean, it's a very successful business. Like, I mean, when I called you, I was like, yeah, it'd be a cool idea, but I did not expect it to do what it's done over the years. So it's been like, that's something that you and I will always remember our entire lives, is being like, not many people get to do something like that, like grow a software company from literally the ground up. You and I both stuck $1,000 into a checking account.
Oh, and then we just, I forgot about that.
Yeah, dude. It's it's a really cool story when you think about it. Like, me and you literally opened this checking account together. We filled out all the tax stuff, got the business open, got the LLC started. We each stuck our $1,000 in the account, and that was it. I don't think we ever put any additional money into it. We literally bootstrapped it and started out as cheap as possible, and just kind of slowly progressed as the business started generating some revenue. And dude, it was I talk about to Lindsay all the time too. I'm like, it was such a fun time in my life, was being able to grow something like that. And I've been missing that, so I'm excited to kind of see where this whole hard money lending and stuff goes. But yeah, man, it was a fun time.
Yeah, it was. Yeah. And like, I heard a quote once, and it was like, I wish you could, I'm going to butcher it, but it was like essentially to the point of like, I wish you could know in the moment, like when the good times are, so that you can soak them up, rather than like looking back and be like, oh, those were the good days.
Yep.
And that was it, like 12-hour days, and you're just hustling and you're grinding and shit's broken all over the place, and customers are complaining, but like,
we got an hour-long Zoom call trying to figure out some simple freaking equation that's not working.
Yeah, we're like doing like math on the back of the napkin because it's just not adding up. And I'm like, dude, I don't understand why this isn't working. And like, oh yeah,
bad contracts going south. Oh, dude. Yeah. Oh my gosh.
It really is the journey, not the destination. Yep. But yeah, we kind of like, you exited that company, and I'm still very, very active in that. Mm-hmm. But you've now kind of moved into the mortgage space, and I'd love to hear kind of your background and your thought process on that, and how you kind of got started with all that.
Yep. So I purchased my first 2 rental properties back in 2019 and 2020. And I knew after purchasing those, I always wanted to get into real estate. I mean, back in like 2017, 18, I think is when I first caught the like bug of like reading the Bigger Pockets, forums and talking to people at local meetups and stuff like that. And finally, I just pulled the trigger. I told my wife, I was like, babe, we either have to do this, we're in or we're out. I was like, I can only learn so much. I can only read so many books. Like, everyone's saying you just have to jump in and go. So like, I just did it. I bought a rental property. It was out of town. So I purchased that rental property, and I knew I always wanted to get into real estate. Like, that was something I could tell was my speed. It's what I would enjoy. Well, I had YouTube. I was growing at the time. We started growing the dividend tracker. And then my family and I also decided to go travel for a few years. And with that, I didn't really have the time to really look into real estate that much, because I knew we weren't settled down. I didn't know where we were going to go. It wasn't something that was my priority at the time. So I took a break, for 4 years, which looking back now, I wish I just would have bought everything I analyzed. I'd be sitting pretty right now. But now that fast forward a little bit, a few years later, my family and I have finally planted roots. We know we're not moving anywhere. We purchased what we think will be our long-term home. And so I knew, like, now that I'm settled, I can kind of open up that, kind of page or that chapter in life that I was really wanting to get into a little more, and that's real estate. So I started going to real estate meetup meetings and was meeting people in the space, a lot of big investors in the area. And I also knew that so YouTube right now for me only takes like 8 hours a week, tops. And so I have all this extra free time, and I didn't really have anything else that I was growing. Like, I wasn't working on nothing else except just making my 2 videos a week, and then I'd work around the house or spend time with family, which is great, but that starts to weigh on you a little bit, especially guys like you and I. So I was like, I need to get back to something. I need to get into something that I can grow, that I can start. And I thought of getting more into the career side of real estate while also investing on the side as well. So that's what I'm doing right now. I got a flip I'm working on. I also have I have 1 hard money loan out that I have going on right now. I've done 3 of those now. Excuse me. And then I've recently passed the mortgage loan officer exam, and I have my mortgage broker license. And I'm working for a broker and trying to grow my kind of network in this local space in the real estate market. 1, to grow a career in this because I see me doing this for the long term. But two, I'm getting connected more in the real estate market too. Also, my plan is to have those connections help my investing side things grow as well, with connections with realtors, figuring out when properties are coming up, meeting different wholesalers, and the whole 9 yards that comes with all the moving parts of real estate. That was my long story on how I kind of thought and got into this.
No, that's great, and it brought up a couple points. But I actually was on a podcast, I believe it was last week that we recorded it, and it was with a guy named Tad, and he had a similar story where he was in the mortgage space, and then he got frustrated by actually all the red tape and the Fannie Freddie guidelines, and sorry, we don't have a loan product for this, or we can't lend on this, and all that. And that's actually what kind of triggered his move into hard money, because he's like, look, there's an opportunity here, and we're turning away like 50% of the people because it's like a non-conforming loan, or we just don't have a product for it, or it just doesn't work. And so that's what ultimately led him down that path. And he just liked the flexibility of that, where like ultimately it's your money, so you get to have the final say on whether you do or don't do it. So I'll be curious to see 3, 4, 5 years down the road from now if you feel the same way, if it's like really frustrating, or it's just kind of like the nature of the job, or however it works. So it'll be really cool to see.
Yep, time will only tell. And right now, as you could tell from my reel today, I'm standing on a street corner trying to get business. So
looking like a hobo with a cardboard sign, I love it,
dude.
Grassroots. Man. No, I love that. So really quick, I do have a question. Do you have like an office that you go into, or is it all like fully remote? Like you do everything just from home?
It's like 50-50.
Cool.
So the team I'm working with is a super, super great bunch of guys. And I kind of gave them a heads up, like, hey, this is what I got going on. This is my background. This is kind of everything. Like, I have a busy schedule, but also I'm dedicated to this, and I really do want to grow my business. And they're like, yeah, no worries. I told them I already had a office set up, which is what I'm in right now. And I've been working from home for the past 5-6 years. So if I was to go into an office setting, full time, I know I couldn't do it, because I've gotten so used to working from home. But from working by myself for so long, I've been eager to get back into an office setting because I missed that camaraderie, dude. I really do. Like being in construction and stuff previously, before the internet stuff all happened, I really didn't miss giving shit to all the guys and hanging out in the office during the day, like just the relationships that you build. Yeah, dude. I like that, and I'm a very I like to make relationships with people, and that's something that I really do enjoy in life. So I knew I needed that in my life, and so to answer your question, it's probably like 50-50. It's up to me when I want to be in there, when I want to be out. There's a couple of meetings I have to make like during the week, but I would say I'm probably going to be 50-50 as the time goes on. I could see a lot of the phone calls and stuff, though. I do like taking it home. I'm not a big fan of like being on the phone in front of a bunch of people. I just don't like that. Like I can do it. It's just, I don't concentrate as well.
Yeah.
I miss out on stuff they say and all that. So the big important phone calls, I'll probably try to take it home, and then cold calls and stuff I can do in the office. I'm not worried about that.
Wow. Okay. Very cool. And there's so many different avenues. Like before we even started recording, we were talking about social media, and you and I, like, we're both active on social media, and it's in this day and age, like you really have to have a social presence. Like I've spent probably hundreds of thousands of dollars on Google ads and Facebook ads and different things like that across all the different businesses and companies I've ever done. And I remember my eye was opened once when I posted a TikTok, and it really didn't like get that many views. I think it was like maybe 1,800 or maybe 2,000 views. And I remember getting like 17 sales from that video. And it was just like, whoa. Whereas before, like just that same week, I had spent probably $5,000 on ads and gotten 0 sales. So the impact of organic. So I know that's kind of like outside the scope of this episode, but just a really cool like topic to touch on. And maybe we do another episode down the road on that. But just, you talking about standing on a street corner trying to get business, like the social media side of it is really powerful. And I know it'll do well for you.
Anyone who owns a business should be making content. And I know a lot of people will look at it and be like, oh, I'll never go viral, but you don't have, that's the problem, is like, I think a lot of people just don't know yet. Like the true power that can come with posting on social media is like, you don't have to have a shit ton of followers and all these views. Is this, if you find a niche that you can get into and you can get some sort of viewership, over time by staying consistent. As you and I both know, consistency is key when posting on social media. If you post once a week, you're not going to get any viewership.
Right.
But the more consistent you are, yeah, like you said, it doesn't take a 1 million viewed video to be successful on social media. I know guys who have less than 10,000 subscribers and they're killing it income wise by products and whatever they're selling, through their social media. It's truly, truly powerful. And once people, I think, like tap into this market and they really start seeing like, holy crap, some of these people are doing this on social media, that's when everyone's kind of eyes open up. They're like, okay, maybe I can make 1 or 2 cringy videos,
Yeah.
It's worth it.
Yeah, it is. Well, and you made a really good point too, is like you actually, I would argue that you don't actually want to go viral unless that specific video is in your target niche.
Yep.
So for example, and I'm sure you've seen this one, my first like truly viral video that got like 3 or 4 million views, like it was of a stupid bumper sticker that I took a video of while I was in the drive-thru, and it got like 4 million views. And the thing is, like, it's a bunch of like hillbilly hicks like commenting on the dirt bike, and like it was just like, it was stupid. None of these people are like are gonna like buy my thing or be interested in lending or whatever it is. I would much rather have a video that got 2,000 or 4,000 views that have, I mean, that's 4,000 eyeballs of people that are interested in what you're doing.
Yep. It's powerful.
It's just
for
crazy.
Free.
Yeah, absolutely. And like you've had multiple videos that have gone viral on Instagram. Like I still laugh at the one with your wife doing the weights, I look like a bird, and fucking hilarious. Like,
how many views that thing has?
Get? Like 40 million?
No, it's like 60 something now. Like 60.
Oh my
gosh. Last time I checked, I mean, I can look, but it was like, it got up to like 65 million or something like that. It was insane.
And for anybody curious, like how much money did you make from that video?
Oh, being on Instagram? Not much.
Like a couple bucks, if that?
No, I made more than that. So Instagram and Facebook started paying around that time that I posted that video.
Okay.
There's like a creator program you can get into. But yeah, I mean, I probably made, I don't know, $20 maybe off of that. But like,
right.
And dude, if that was, so here's the other thing. If that was a long form video on YouTube, I would have made hundreds of thousands of dollars on that video.
Yes. Easily.
Maybe I may have to say million. I don't know, dude. Like, think about it.
With 60 million views, you probably would have.
Yeah, I think I would have.
It's insane. So anyway, all that to say that like, you don't have to go viral. Like, it's way more important to like be in your target niche, because you can sell whatever, and it's way more applicable to the people. So anyway, I don't want to go down that rabbit hole too much, because we can geek out over the social media, but I do want to segue over into the lending side of things, just because obviously it's the lender podcast, so we need to stay on topic. But I think that's it's like I said, it's going to be very interesting to see how you go from like the traditional mortgage market and industry, and then what I don't know, just to see side by side the comparison and see what you think between the two. It'll be really cool to see.
Me too. Yep, I'm curious to see how it goes, and I mean, definitely, I feel like, just to compare it right now from what I've done already, is like the mortgage lending space is definitely the very conservative, tons of rules, to where hard money, private money is the wild, wild west.
It is. Yeah.
That's the way I look at it. And that's what it feels like,
Yeah, absolutely. So tell me, I didn't know you'd actually done 3 loans so far. I thought you had just done your first. So tell me, if you have time, give us the context on all 3. How did all these kind of start?
So it was all John. All 3 were John.
Okay.
Yep.
Okay.
So a little different than it would be if I'm doing something like with a brand new borrower, which I'm actually in the works right now of doing my first hard money loan with a couple that you and I have kind of discussed a little bit, on a deal that we're looking at that is still it's in the air right now. They haven't officially got the deal yet. They're trying to work on that, but we're trying to do the process, which this is literally perfect timing for this podcast, because I can literally think of all the things that I need to go through with them this is what we're going to talk about on today's episode. So it's going to be great.
I love it. Okay, perfect. All right. Well, yeah, let's dive in. We can, let's talk. So the first two that you did with John, and just for, again, context. So John is a private lender himself. So essentially JJ was a capital investor in his deals. And how did that work out for you? I assume everything went well.
Super smooth. I mean, I felt really good knowing somebody to kind of like get my feet wet in this industry or this space. Because like when you're lending, 6 figures worth of money, it's a big deal, man. I mean, it's scary your first time like wiring money to some dude, which I mean, look at that. I mean, I have a relationship built with John. And I know what
met this dude over the internet. Yeah.
Literally another internet friend. Yeah, exactly. So like it was nice to be able to just kind of be at ease, but still, I'm on alert because I'm sending some guy in West Virginia
6 figures. Yeah.
6 figures worth of money. So, but yeah, no, it's, and he also likes to joke around. He likes to say, thanks, man. This is going to be my down payment for my Lambo. And he's like, all right, you're a funny guy over here. So they did great. So the first two were together. They're at the same time. And we did, I think both of them lasted around 6 to 8 months.
Okay.
And then one we have right now, which is about to close in the next week or two. And then I'll have all my money back from him. And then I'm looking to turn around and kind of have like a separate pile for my hard money loan money. So like kind of to keep it its own little separate business and just kind of see where it goes. And I kind of want to see how that capital grows compared to the rental property account and the flip account, and just kind of see like what's working the best and what's taking most of my time, which as we both know, hard money is just so nice it comes to
it's very passive.
Very passive. So yeah, I mean terms were 6 months or a year, 10%. And if I don't think I'm missing anything.
Okay.
2 have closed, one's still open.
And then did he, so like for the 6 month or year long term, have you been getting monthly payments? Does it all compound and you get paid on the back end? Like, how does that work?
So with John, it all compounds. He pays me on the back end, which is fine. And I'm getting my money back. But moving forward with working with like these people locally, like I'm taking interest only payments.
Gotcha.
That's one thing I want to do difference.
Okay.
So
perfect. And, I think you'll find too, like it's very like segmented. Like people choose, they either like one or the other. And there's pros and cons to both sides. Like for example, like I do the, it all accrues and it pays off on the back end. Just from like a accounting standpoint, like when you have 2 or 3 loans out, like it's easy, right? But if you've got 25 different loans and they've all got monthly payments and different borrowers and stuff, like it becomes an accounting nightmare in QuickBooks. And you're like, then you have to take those and just like disperse it to investors and kick out 1099s. And it's just like, it can become like a logistical nightmare if you're not super organized.
Yep, I could definitely see that. So if I ever get to that point where I'm doing that many loans, then yeah, I probably would just say pay at the end, compound pay or, total payment at the end, lump sum. But right now, I don't see myself doing more than probably 1 or 2 at a time. Okay. So, and I like that aspect of just like feel like I'm getting something while that money's coming in.
Totally.
It just feels nice.
You don't want to wait 8 months to get paid back. Yeah.
For sure. But yeah, definitely if there's a higher volume of loans, I could see how that's definitely beneficial to wait on the back end to get that one payment instead of 25 payments a month. And if one's late, where's this payment at? Yeah, that would be exactly annoying.
Yep, they tack on late fees and all that stuff. And
for sure.
And we've actually found too, like we have some bigger investors like with, $500,000 or more. And when you take those funds and actually divide it across multiple projects, they're all paying off at different times. And so it's almost like you're getting monthly payments kind of, they might be like, you might get 2 weeks and then another one pays off in 6 weeks or 8 weeks, but they're semi-regular. And so I found that investors for the most part have actually been okay with that model.
Well, let me ask you this then. As a new guy who's getting started in the space like myself, would you recommend just keeping it the way it is? Like just have that lump sum payment at the end and not even worry about interest-only payments? Because that may also be a highlight or a feature that I offer as a private lender to a borrower saying, hey, don't worry about making them monthly payments. Just pay everything at the end whenever your project's completed and you got the extra capital.
Yeah. Yeah. It's a really good question. So like I said, it's really 50-50 and it's all just personal preference. The reason that I do mine the way that I do is because, as you know, I had a background flipping houses for like 5-6 years.
Yep.
And for me, like when you have multiple projects, like sometimes we would have 6 projects going on at the same time.
Mm.
Um, my lender didn't require monthly payments. And as a borrower, I loved it because like these are some pretty big loans, like $250,000 across 6 projects. I would have had to pay $30,000 to $40,000 a month in interest only payments. And when I'm going to a lender in the first place, the reason is because I don't have a ton of capital anyway.
Right.
And so for me, I really liked that it could just accrue and pay off at the end because that's a lot of cash to be going out every single month, and that would really stress me out. So
For sure.
I just took my kind of lender's model and did that. But there's also a lot of like benefits to collecting monthly payments. Obviously, you get paid every month, but you also like you can spot problems ahead of time. So like if they make 3 payments and then they stop, you're like, okay, I got to jump in here. Whereas if it all accrues in the end, you might not know that there's been a problem for 6 months,
Right.
so it really just depends. I think there are ways to mitigate that in the sense that like you could, like you just increase your communication. So every 45 days, give them a call and say, hey, how's it going? It's just a little bit less automated. So all that to say, I don't really know. It's all personal preference and you choose what you do. But I really like having it all accrue at the end. And like I said, my borrowers really appreciate that as well.
For sure. No, that's good.
Hey, really quick, I need to interrupt the episode to talk about this week's sponsor, which of course is Lender. Lender is a hard and private money origination and servicing tool. So if you're currently using something like Excel to handle all of your business needs, it's about time that you upgrade to something a little bit more sophisticated like Lender. Lender helps you handle all of just the nitpicky, nuanced, tedious things that we have to do as lenders, like dealing with loan doc generation and preparation, or dealing with document storage, or collecting files from all of the borrowers and LLC docs, collecting monthly payments, and then at the end of the year having to deal with tax statements and generating 1099s and 1098s. It really is just a one-stop shop from start to finish. It helps you all the way from origination through servicing to payoff. It automatically generates payoff statements for you. You don't have to miss any extension fees or deal with prorated interest. It's just the whole system handles it for you. So if you're currently using something like Excel, I highly recommend that you upgrade to something a little bit more sophisticated just to keep your borrowers all organized, just to keep your investors in the loop, and I highly recommend it. You can check that out by going to joinlender, lendr.com, joinlender.com, and check it out. And I know it's going to transform your business just like it has mine. Now, back to the episode.
So I got some questions here that I want to ask you in the process that I'm in right now of
Sure.
obtaining like my first non-relationship that I've known previously to lending with this couple. I met them at a real estate meetup. Great couple, sweet people. First question to you is, how, when you meet that potential new person you're going to loan this money to, how do you decide on the loan terms? So like, how many points are you charging up front? Do you have a minimum amount that you charge them on, no matter what size of the loan is? If it's a $50,000 loan or a $500,000 loan, and then what is that interest rate look like? Is it the same for every project? Do you have scenarios where it makes a little bit higher interest rate versus a lower? What does that look like on your end?
Yeah, super good question. What I do is I am the same all across the board, every loan, no matter what. The biggest reason for that is like I said before, if you have 2 or 3 loans, like it's okay to be like, okay, I can remember this loan has 12%, this loan has 15%, this one's 2 points, this one's 2.5, whatever. But once you get multiple, and I know it doesn't feel like it now, but you will scale up really quickly. Mm-hmm. I know it doesn't feel like it now, but you will soon get 20 loans simultaneously. And then it's just a nightmare to remember, unless you have like some software or something in place to help track that. It's just so much easier to know, like across the board, I am 3 and 14, and everybody knows that. And I can quote that to anybody. I don't have to like look at the deal. We do have some like minimum origination. So like if it is a really small loan, like a $40,000 loan, 3 points on that's going to be $1,200, which for me is not really worth it. And so I always have a minimum of like $2,500 at least. So if it's $2,500 or 3 points, whichever is greater.
Got it.
And that's worked out well for us. The other thing I would say too, sorry, and then you can cut me off. But I just lost my question. So go ahead.
Well, let me jump in here then while you're thinking about that. So you said 3 and 14. And is that because of where interest rates are right now? Like, how did you come up with that? How do you know that's a good amount? Because like what I was thinking with this couple was 2 points and 12%. Is there does the stuff? I just don't know this. Does stuff differ based on where you're at in the region? Like, I mean, up in Idaho, your cost of living is a little higher than what it is down here in Missouri. Mm-hmm. Do you take that into effect, or no? It's like no matter what, you're offering 3 points, 14%. Take it or leave it.
It's a good question. So when I was borrowing money, it was a pretty standard like 2 and 12 across the board. Like that's actually a very common rate and fee structure in the industry. I am not afraid to be a premium product, because every single day, like I'm not even exaggerating, every single day I have somebody call me and say, look, I was going with this other lender. They have been dragging their feet for 45 days. I am about to lose the deal. Can you close this in 2 days? And I'll say, sure. Yeah, numbers look great. Like as long as title's done, like we're good to go. Every single day, not exaggerating, like people call me with this situation. And so I'm a commodity. I'm a premium project. And like I turn people away initially because they will say like, oh, that's a little steep. Like that's more than I wanted to pay. But probably 70% of the time they'll come back and be like, okay, let's just do it. Like I don't have time to waste. I'm going to lose out on the deal. So I would not be afraid to, I would not be afraid to provide a service that's super convenient to people.
Cool. No, I like that a lot. And that's one thing you and I bickered back and forth with on the business side of things is Bryce was always the premium side. I was always like, no, keep prices low. And then when we went with the higher, prices and stuff, and we're like, because we weren't charging for what the value we were giving for our product. And once you kind of explained that to me, and then we saw actually an increase in revenue when we made those changes, I was like, it's a no-brainer. So I have come a long way since then.
And it's a difficult lesson to learn because you want to provide your customers a good discount. But what I've come to learn is in business, pricing is one of the biggest levers that you can have. It's one of the few things that you actually have control over. And by charging more, you actually garnish a better customer.
Absolutely.
More often than not. You really do.
Yep. And less headache.
Yeah, absolutely. It's a win-win all around. Like you make more money, less pain in the ass. Like it's great.
Yep. So we talked about loan terms, kind of how you come up with that, what your amount is. My next question kind of goes with that is as far as long-term duration. So on your contract, what's your duration for your loan? What does that term look like? And then also what happens if they go over that amount? Like if let's say they got a year and then they have to pay that back or whatever it is. What happens if like, hey, I'm 13 months in, I'm almost done, it's listed, it's just taking a bit to sell. Like how do you go about stuff like that?
Yeah. Super good question. So we are actually a 6-month term, and then we offer offer 2 optional 3-month extensions for an additional point each, up to a year. So if they take longer,
interest rate would stay the same.
Correct.
But they have to pay you an additional point.
Yes.
Okay.
Got it. So if they take up to a year, it would actually be 5 points instead of the 3.
Cool. Smart.
Yeah. And it's worked out really well for us. And it's another way to kind of like offset that like, that's a little bit expensive. Because if I were to say, oh, we charge 5 points, people are like, all right, get lost. There's no way. But it's on you. If you take longer, I've got to make sure that my money is always moving.
Well, go ahead. Well, this leads me into my next question. So if you're not done with that, finish your thought.
I was just going to answer the second half of your question, like what happens if you have to extend. You'll find too, and I started to go down this rabbit hole when I first got started because we were a little bit more constrained on capital. And what a lot of people would do is they'll actually sell their loans off to the secondary market. I don't know how familiar you are with that.
Yeah.
But what I didn't like was if I do that, I lose a little bit of control. So for example, let's say I have a really good borrower and They, everything has gone wrong, and unfortunately, we're coming up on a year, and the property's not done, and it's done, but it's still on the market and hasn't sold. If I were to be like this hard ass that says, nope, you're at 12 months, and we're going to start the foreclosure process, like, is that borrower ever going to come back and use me again? Like, no, of course not, because I was such a tight ass. Whereas I have had projects that are like, you know what? I get it. I flipped houses. The market is not in your favor. It's not going well. If it takes 14 months, maybe what we do is we just we settle up on the interest that's owed. And then we just, we'll continue on for a couple more months, or we'll reset the loan, or whatever it is. It's on a case by case basis, but I just like to give the option to be able to extend if we can. But all that to say, if they're like a really shitty borrower and they're like dodging my phone calls and playing hard to get and all this stuff, like, all right, we're going to start the foreclosure process. The biggest thing is just communication. Let's stay in touch. Let's make sure that this is a win-win for both of us, and then we'll both make out okay.
Okay. And then foreclosure process, basically, how does that kind of entail? Have you had to do that yet? And if you have, how does that work? Do you contact a lawyer, say, hey, let's get this rolling. Here's the contract. They are past due on terms, everything, all this. What does that kind of look like on your end?
Yeah, absolutely. So it varies a lot by state. Luckily Idaho is a red state, so it's very lender friendly. There's two different segments. So in Idaho, the way it works is if it's a property that is 20 acres in size or less, the foreclosure process can take about 6 months. If it's 20 acres or larger, then it's, can take up to a year, different things like that. But to answer your question, really, I don't handle that. I just I talk to my attorney and be like, look, we got to start the foreclosure process. They'll go ahead and file a notice of default. And usually at this point, it's because, like I said, they're not answering, they're dodging phone calls. They're not trying to if they stay in contact with me, most of the time we can remedy it in the sense that basically what I'm trying to say is you really don't want to go down the foreclosure route if you can help it.
Right.
There's lots of ways that you can do it's called a deed in lieu of foreclosure. And so actually, rather than starting the foreclosure process, they can just deed the property back over to you, and you just take it over, and then you handle it yourself. And some lenders will even make you sign a deed in lieu at closing. And they'll have you sign it, but they just physically won't file it with the county courthouse until if or when there is an issue. And then they just be like, okay, cool, here you go. I take the property back, you're in foreclosure, but then you don't have all the legal fees and all that kind of a nightmare. So there's different ways to go about it.
So 2 questions about that is the deed in lieu. Is that something you set up on the front end before you even wire funds? And that way,
part of it's part of the documents that they sign at the closing
cool.
table.
That's good to know.
That's less common in this industry, but it's kind of a good little hack. The other thing that you can do is something similar. You can have them sign a quitclaim deed at the title company. And then it's very, very similar in the sense that if something happens, you just file this quitclaim. Cool, I take the property back.
For sure. Another question, the second part of that question on that is, how did you find your lawyer? And is he like a real estate focused lawyer for these types of deals?
Great question. There are a lot of people who say they're real estate attorneys, but what they really mean is they've helped a couple people buy and sell properties privately. Right. Those are not the people that I typically recommend, just because private lending is a very niche. It's very, very unique. There is a law firm called Geraci, Geraci, out of Chicago, and they exclusively specialize in private lending.
Oh, nice. Okay.
And it's really good. And they've got this system called Lightning Docs, which is really cool. So you can go in and it's basically a document generator, but you go and you plug the borrower's name and the co-borrower and the loan amount and the different things like that. And then you select your state and all the different things, because they have it broken out. These are the specific laws in Missouri or wherever.
Oh, wow.
And then it is a little expensive. You're probably $400 or $500 for that. But then they'll kick it out and it's specialized just for you.
Well, and I'm sure that's money well spent. If something ever goes south really quick, you're going to be very glad you have them on your side.
Totally.
Yep.
So I would highly recommend that. They're also really good as far as just like a compliance standpoint. Like some people are like, I don't know, like, do I have to have a license in my state? Do I not? Like, it's
Okay.
hard to know. Like you can honestly call them up. They'll do like a free consulting call and be like, I live in the state of Missouri. I'm new to this. What do I do? And they've got everything lined out for every single state everywhere.
Yo, that's huge.
Yeah,
That's golden
very
right
good
there.
to know. Yep.
Cool. Okay. Well, moving right along then. So we've talked loan terms. We've talked what happens if they go over duration. Now we're at the like kind of payout stage. So, we've done closing, we've signed the papers, they've got their disclaimers, all that. How do you disperse the money to a borrower? So let's say they have a property that's $100,000. They need that to purchase. So then, and then let's say it's 50,000 to fix that property up. So their budget is, thinking this project's going to cost them 150 total into it. How do you go about giving those borrowers that money? So you obviously need to give them the 100K up front to get the property. But are you giving them $50,000 up front as their construction loan as well, or to fix up the property, that remodel budget? Or are they going to pull draws like you would in the typical building phase of a new home? What happens if they go over their budget? Do they have to pay more points? Like, how does that whole process work?
Yeah. Super good question. So first and foremost, for the initial purchase, you never, ever, like just give the funds directly to the borrower. Like everything will always be done through the title company.
Great point.
You make sure that we make the borrower pay for both a borrower's policy and a lender's policy. They cover the cost on that. And title make sure that like title insurance is in place. Like there's no issues with the legal description or encroachment or easements or anything like that. It's all insured and covered.
And this is all borrower paid? Sorry to interrupt you.
Yeah. Okay. And that's the nice thing about the private lending industry is like, again, you make the terms. Like you can make them pay for whatever you want. And if they don't like it, cool, they can go somewhere else. So cool. It's really flexible. Like unfortunately in this industry, there are a lot of things known as like junk fees. So people just like, they'll charge like a $1,000 commitment fee. You're like, what the fuck is that? Like, what's a commitment? Yeah. And like some people, but other people will charge like a document prep fee. So like the $500 fee to Jurasi, for example, they'll throw that in their docs because
that's smart.
Like, why would I have to pay for that out of my pocket when this is a loan for you?
So for sure.
So you get to choose all that kind of stuff. But some people like those kind of fees, for example, like I charge a $40 wire fee. My bank charges me a fee to wire funds to the title company. So you're sure as hell going to pay for that. But like commitment fees, all this other, like I try not to be just like a points machine, like I want to offer a quality product. But yeah, you set the terms and you get to decide what you want to do. So everything goes through title. And then say, for example, in this like $150,000 circumstance, I will file a lien on the property for the full amount, the $150,000, even though I'm only distributing $100,000 initially.
Okay.
So it's just an initial security so that like if something happens, you have some legal standing that like, no, this is a $150,000 loan, even though I only dispersed $100,000, I'm going to get all this money back.
So how do you do that? Sorry, how do you say, hey, I'm putting this? Is this through your lawyer or how does
this is all through the title company as well?
Okay.
Yep.
All right.
So like you'll set up. So we have like we have some it's called a lender instruction letter, and it gives the title company step-by-step instructions on what they are or are not to do. And you put all their like your fees and everything in there. So you say these are our origination fees. These are supposed to be paid out at title, or we're going to wrap these in the loan amount and they're paid out on the back end. Or this is our commitment fee. This is our wire fee. This is our recording fee. This is our document prep fee. You decide everything. And then you also say like, I want lender's policy in this amount, in this dollar amount. Or like some people even do like 120% insurance policy. And again, the borrower pays for it. So like, cool, whatever. So you specify everything in there. So in there, I'll say the loan amount is 150,000, but initial disbursement is only going to be 100,000. And then they'll put a lien on the property and you're good to go.
Cool.
As far as the draw process goes, we actually don't offer draws on our product. It's kind of just another security thing. So like it basically makes sure that the borrowers have skin in the game, because they have to have like enough capital to be dangerous, in the sense that like they don't have enough for the full project, but they're going to have to fund the rehab. They're going to have to be conscious of all that. Again, that's very abnormal in the industry. Most people do offer draws. And so in the event that you do want to do that, what you'll do is like, we will require like a scope of work. So they'll have to say, okay, it's going to need a roof, it's going to need paint, it's going to need carpet, it's going to be this. This is what it's going to cost for materials and labor. And you're the first line of defense. You got to look at that and be like, I think you're a little bit low on this. Like, have you done this before? Because this is like, there's no way your carpet's going to be $500. It's at least $4,000.
Are you looking at that before they sign the papers at closing?
Absolutely. Okay. That's part of the underwriting process. Like, we don't do any of that beforehand. Like, I want to see, like, you know, do they basically know what they're doing? Like, is this just a pipe dream? Like, do they think it's going to cost $5,000 to rehab a house that's really 50, or whatever? So, I absolutely want to see that. I want to see, and then other things, for example, like we have caught stuff. For example, there was a brand new borrower who came to us. The deal looked pretty good, but then when I looked at her scope of work, she put in a line item there for like extending the garage. And I was like, can you like explain this to me? Like, are you building it out deeper or what's going on? She was turning a carport into a 2-car garage.
Oh.
And I was like, okay, that's fine. But like, anyway, so I went out and looked at the property. There was the house, there was the carport, and then there was maybe
property 5
feet of side yard on the side of that. And I'm like, how the
hell
are you going to extend this? Like, no, you've got setbacks and easements. Like, you have to be so far from the property line. And she didn't know that.
Okay, that's so smart.
So shit like that, I'm just like, you know, you can gauge a lot by going out and looking at the property, seeing what their plan is, because they just don't know what they don't know. And so we ended up not doing that because I'm like, okay, A, you can't do this, but B, if you were, it would probably cost you $30,000 to build a 2-car garage, and you're never going to get that money back. It's just not, sorry, this doesn't work. And so we canceled the deal. So, anyway, all good things. So absolutely look at the scope of work. Say that everything is good. You do approve the scope of work and you're ready to move forward with the loan. You close the property, and then we'll do an initial draw, for like, usually 1/4 of whatever the rehab budget is. So $50,000, we'll give them a $12,000 initial draw. And before they can get another draw, they have to submit photos and receipts that the work has been done. And they also have to have signed releases from the individual contractors that they used, saying that, yes, I have been paid. And that I can't file anything against this property. So
very smart.
Say they, you know, they say that they paid a contractor, they made up like a fake invoice or whatever, and they ran off with the money. Unfortunately, the contractor can go and put a mechanics lien on the property, and then you're hosed. Mm-hmm. So before the contractors are paid, you have to like get signed releases that says, yes, I've been paid. I like relinquish my rights to be able to put a mechanics lien on this property. And once we have all that and we've seen that like the work has been done, then we'll go and do an initial draw, and then the process repeats.
Got it. So correct me if I'm wrong here. So they have the contractors have to sign this paper stating that they've been paid first before the money is released. So are you saying that the borrower has to pay the contractor with that's where their skin in the game is by paying that contractor first? Once Correct. They've been paid, then they can draw out that money for whatever they need to use that for the next project
Absolutely.
Or whatever.
And then there's you can do it either way. So like you can either front them the money, or they can cover that with their own funds, and then you reimburse them.
Okay, I like that.
You can do it however you want.
Okay, and sounds like there's a benefit in them paying the contractor portion first, because like you said, their skin is in the game too. So they want to. It's a little easier to spend somebody else's money than it is your own.
Absolutely.
Okay,
Yep.
Good. No, that's super good. So the next question I had on here, we already kind of answered. It was, do you use a lawyer or title company to send funds to? So it sounds like everything gets sent to a title company that's in like an escrowed account. Mm-hmm. And then whenever they need to make a draw, or whenever you're dispersing the first funds to go purchase the property, do you give the okay to the title company to say, yep, you can release these funds to the borrower, or does the borrower have to come to the title company? What's that process look like?
Yeah, and again, like I said, I keep saying this, but you can do it either way. So
Okay.
as long as I have the lien in place, I actually just submit the draws myself. So I'll just send them like an ACH request, and they'll just get the money themselves
To the
because I
borrower?
already have the lien correct to the borrower
Okay.
directly. Just because I already have the lien in place, so it doesn't matter.
Got it.
You could do an escrow holdback through title, and then they like disperse those funds if they want. I just like the flexibility of hanging on to the money myself, and then
For sure.
but I have seen lenders who have gotten in trouble because they have promised X amount of rehab dollars. And then when the borrower comes to request them, they said, sorry, we don't have the money. So,
Oh,
because that could, like you entered into a contract that says this is the purchase price and this is
Yep.
the rehab amount. We're going to give you draws in X amount. And then, sorry, we don't.
dang.
That, that could get in trouble. I don't ever foresee you having that issue, but I have heard of that. So,
Yeah. Well,
something
no,
to
that's
keep in
something to
mind.
look out for as a lender too. Is like if you're getting into a loan, make sure you have the capital
For
to
real,
cover what you're lending for.
Yeah, you're obligated to your side of the contract as well.
Absolutely. No, it's super smart. So here's one where this is where my mind first goes to, as you'll know me. When it comes to lending money, what is the biggest risk? Like, what's the one of the biggest things that could go wrong as a lender, and what should you look out for, and how can you prevent that?
Yeah, I mean the biggest thing is you lose all your money, like
Right.
plain and simple. Like you could. So there's a lot of wire fraud going on right now. So that's huge. Like people will make up false settlement statements with false like wire instructions and payoff letters, and they'll send it to you or the title company, and people have lost like six figures just doing that. So like
Oh,
we
God.
always, can you imagine? Like
Oh,
luckily that's
dude.
never happened, but it makes you sick.
Yes.
Yeah. So the biggest thing is like before you wire any funds, you call that title company and you confirm the wire instructions every fucking time. Like
Yep.
no excuses whatsoever. Even if it's a title company you've worked with 10 times in the past, like
Still do it.
double check. And you call them, they don't call you.
Okay.
So
That's but also good to know.
So luckily we've never had that. I hope that never happens, but like I have heard of people that happens to. So
okay, so that's the wire fraud side. What about the side where you have a borrower who just like market, let's say in 3 months after the election, the economy just tanks. And you have, let's say you have 3 or 4 borrowers out there that are kind of like, dude, sorry, Bryce, like I have nothing. I can't do anything. What's that process look like on your end as the lender? Do you take the property over? Like what's that look like?
Good question. So we just for easy numbers, for example, let's say $100,000 loan amount. $100,000 purchase price. We will never ever do $100,000 loan amount because that's 100% LTV, and there's no leverage. There's nothing there. There's no like wiggle room. There's no cushion. So we will always require at least a 20% down payment from the borrower. And that will cover just about, and sometimes we'll even do more, we'll do 25 or 30%, just depending on like how comfortable we are with the deal. And this really just comes down to you as the lender. Like what's your risk tolerance? How comfortable are you with the numbers? How well do you know the numbers? And we just make sure that like the borrower has to have skin in the game. And so we always require at least 20% down. And the main reason I use that number is just because if you look historically at the market, like something catastrophic would have to happen for the market to plummet more than 20%.
Right.
It's just not, in my opinion, it's not likely. All that to say, though, that also keep in mind that these properties are typically already, like if you're flipping a house, you're going to have a good enough cushion anyway because you're already 40 to 50% under market value because it needs some work.
Yep.
So if you take that 40 to 50% cushion and then on top of that, you add an additional 20% to that 40 to 50%, you've got a pretty good like cushion there. And then to add on to all of that, the riskiest part of a deal is always on day one because no renovations have been added. Nothing has been done to the property. Your best position is on day 180 when the project is completed. They've put all their own funds into the rehab. This property is completely renovated and it's just sitting on the market. In the event that something has to happen and we foreclose, we make hay. We do amazing because we take the property back that's been fully renovated, and now we just maybe have to take a little bit of a haircut and sell it and make all of our money back.
Yep.
So In contrast to like an FHA loan where you put 3.5% down, you have no wiggle room because it's 3% on a market value property of $300,000. You know, so like in the event that something happens, like you'll be upside down really fast. So again, that's another reason why I love private lending, because the security is just it's incredible. You, as long as you do it right and you set yourself up well, you have so much wiggle room.
Very good. So you're doing a lot of deals now. Do you still analyze every single deal you lend on?
Yes, absolutely. Yep,
yourself?
always.
Do you have a team that does it, or you're looking at every single deal you're doing and making sure those numbers look right? And on top of that, are all the deals you're lending on local, or are they out of state as well?
Yeah. Dude, you're amazing questions, by the way. These are killer. So the answer is yes. I do it myself, and that's the biggest reason is just because like I do have one other guy on my team, but he's never flipped houses. He doesn't have that, so I'm always like the second, like the final say. And I've the nice thing is like I have done enough of these that I can look at it and within 10 or 15 seconds know whether it's a deal. Most borrowers are too aggressive on their numbers. They look at comps that are not super accurate. I typically will take like a borrower's comps and knock off $20,000 or $30,000 and then see if the numbers make sense still.
Smart.
As you know, like with construction, everything always takes longer and always goes over budget. There's always something that goes wrong. So I just want like an additional cushion there. As far as like where we lend, geographically, like 95% of what we do is in our own backyard.
Yeah.
We do have a couple random projects in like North Carolina, Alabama, Oklahoma, which are random. But what happened is we had some really good borrowers and then they moved out of state and then they continued to use us.
Cool.
And where they performed really well, we're like, okay, we trust you. Like that's fine. But like I said, 95% of what we do is here just in Idaho.
Okay. So you mentioned something about checking and analyze numbers that sparked me. Is you said that you flipped homes before, so it's easy for you to kind of look at these numbers. Do you recommend someone who maybe has the cash to, multiple six figures sitting on the sidelines that they could put to work, but they've never flipped a property in their life? Do you recommend them going to flip a property first, or do you recommend that they can still get by in the lending side of things without having that background in flipping properties and being able to look at that and analyze that?
That's a really good question. I think it depends on who you are as an individual. Like I know you personally. I know your background. I know your risk tolerance, and I know you're very conservative. Mm-hmm. For somebody like you, I would say, absolutely, go all in. Like, I know you're not going to be over leveraged. I know you're going to do your due diligence. Yep. You're going to be uber conservative. For somebody who's a little bit more like YOLO, fuck it, let's see what happens. Maybe you would want to like do a couple properties yourself and or like JV with somebody who has some experience, or do like a private hard money deal like you personally have done previously, just to kind of get your feet wet.
Yeah.
Just because unfortunately, you can lose your shirt if you're just too aggressive and you just don't know what you're doing. There's a lot of money on the line.
For sure. No, it's super smart. So another question I have, this kind of goes back to the beginning. I should have asked this at the beginning, but it's all right. When you have a new borrower come to you and say, "Hey, Bryce, I have these deals. I need some money. This is what I want to do." What's your, not accounting for like the numbers on the property, for the borrower themselves, what do you look at as far as, do you check their credit? Do you do a background check on these people? Like, what are you looking at as far as the borrower goes to make sure they're fit to take money from you as a loan?
Yeah, absolutely. So couple thoughts. In hard money, one of the things that gets thrown around a lot is the fact that like, oh, we don't do any credit checks. We don't do like all we care about is the deal. We don't like that's very common like vernacular in the hard money industry is like no credit, no money, like whatever. My personal belief is if you can't handle your household finances, you can't handle my finances.
Agreed.
If you're swimming in credit card debt, there's no way you're going to be able to handle a renovation project, much less like a big renovation project, like $100,000 renovation project. People don't realize like that is humongous.
Massive.
There are a lot of different moving pieces and parts that go into that. So it's quite, it's expansive. So, So we do a credit check, and there's lots of services out there that do that. And again, we make the borrower pay for that. We also do a background check, and same thing, we make them pay for it. I also, and I know we chatted about this earlier, but I want to see some sort of proof or evidence that like they're basically just like a competent person. Like, do you have some sort of do you have a W-2 job? Can you hold that down? Do you have a family? Do you have a wife and kids? Like, show me some aspect in your life where you're already successful and you're like responsible. And I'm not saying you have to be like, a Harvard grad or anything like that, but just like show me that you're like not a piece of shit, really.
Yep.
And then as far
do you
as
Facebook stalk them?
Absolutely. Social media is amazing, especially when they're mid project. Like if there's somebody who posts a lot on social media, sometimes I don't even have to ask for updates on the deal because they're always like, okay, we're doing this. And then if all of a sudden they go silent for 2 months, I'm like, okay, I got to check in on this one because something happened. They've been posting every day for the last 12 years and now something's going on.
They're gone silent.
Yeah. And then the last thing I will say, and this is more of a recent change that we've made, is we will not lend to first-time flippers. If you have never flipped a house, we just won't lend to you because of that experience that we had with that girl and the garage.
Yep.
So we now require, I need to see at least 3 settlement statements of previous projects that you've done, because unfortunately, like I've got my own capital on the line and quite literally millions of dollars from other outside investors, and it's just too big of a risk. Unfortunately, you're not going to learn on my dime.
Yeah.
The only like caveat to that is if it's a really good deal and they are willing to like give up 50% of the profits, I will JV with them and I'll hold their hand and kind of like do that. But because it's more involved and more work on my part, I'm going to take a way bigger cut than my 3 points.
So I want to have some follow-up questions on that, because that's what I'm stumbling into a lot right now. Is a lot of first-time flippers are wanting money from me. Not a lot, but the few conversations I've had, none of them have done a flip yet. I take that back.
Yeah.
The couple has done a flip that was like their own personal home, but they didn't like buy it for a flip.
Gotcha.
So with that, how does that conversation come about? So you ask them like, hey, how many flips have you done in the past? Can you show me proof? Blah, 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 blah. 2, if they haven't done it, you're like, okay, well, Jane Smith, whatever their name is. All right, Jane, well, since you have not done a flip, in order for me to lend you this money for you to get this deal, you're still going to pay 3 points, 14%, but I'm also taking whatever the agreed percentage is of the profits to be able to do the deal for their first flip. But now I'll be honest, if this was my first deal and I don't have any, no one else is going to trust me or anything, and you've checked the numbers yourself and you say it probably is a good deal and they're going to make money on it, I would look at that, me as a newer potential lender, and say, why would I not take that? Not only am I lending them the money and getting interest off that and, points, but I'm also going to hopefully take a chance and see if I get a 50% profit on whenever they turn around and sell that property. I mean, that seems like not a no-brainer, but that seems like a good idea for me, is to test a newer borrower out too. And they may be rock stars. You never know. I mean, it's
totally.
How often are...
And you get a gut feeling for the people. You just know, like, are you a sleazeball or like, it's pretty easy to tell. But just that additional security, I'm like, and I do it a little bit more, I'm kind about it. Like I'm tactful. But like, unfortunately we have like all these other investors, like they look for like a little bit more experience, and that's okay. Like everybody starts somewhere. But one thing that we do offer is, if you can't find another lender who is willing to lend to you because you lack of experience, then one thing that we will do is we'll JV with you on the deal and we'll kind of hold your hand, but we will, because we'll be more involved, we'll take a little bit larger cut than we would typically. And some people have been like, sorry, like get lost, no thanks. And other people have been like, oh, actually, like, let's do that. I would really like somebody to be behind me, holding my hand and guiding me through this.
Yeah. I mean, you're basically paying for mentorship at that point.
Yeah.
I mean, that's what it's, you're, instead of getting all 100% of your profits, like you're paying for, 1, to get the money, but 2, to also have that person to fall back on if times get tough. And you're like, hey, what do I do in this situation? And then someone like you, who's, done their definitely fair share of deals, you most likely have seen that, or from your expertise have a way to figure out, hey, the best way to go about this is XYZ. call these people. And if it's something local, I'm sure you know the guy to call. Boom, boom, boom. Problem solved. Let's move on and get this project sold. And then boom,
Absolutely.
you got 50% in your pocket.
And another thing that I would say is like everyone's so worried about like the points and the fees. Like, okay, 2 points versus 3 points. But the thing is that like, I can't even like the fees honestly are irrelevant. Because if you can't pay an additional $5,000, this deal isn't going to work anyway. You have no wiggle room. But 2, think about it. Like, so we're 3 and 14, but most of our projects do take 6 months. So you're really not 14%. You're like 7%. So you're paying 10% on your money.
There you go.
And all that to say that like some people will go into a deal and be like, oh my gosh, I can't, this is a huge problem. And I'd be like, no, it's not. Like, it's just some mold, like spray it down with some bleach and you're good. Like, and people, rather than calling like and obviously like sometimes you do have to call rehab companies and like hazmat suits and like, depending on how extensive, but like, it's just a little bit of black mold, like spray it with some Clorox and paint it and you're good, and having that experience, quite like you could make more money by just having somebody who knows what they're doing instead of, like for example, I had a guy come to me the other day and he wanted to renovate a property for an Airbnb. Cool. Great. No problem. But he'd never done it before. And so he was saying like, okay, what we're going to do is we're going to make it really pretty on the outside. They've got this long, like tall chimney on the outside. They were going to wrap it in some like special veneer stone to make it look really, I'm like,
oh boy, dude, here we go.
Are you kidding? Like, no, what you're going to do is you're going to call somebody and they're going to come and stucco it for $1,500.
Boom. Done.
It's not going to be a $7,000 like exterior rock job. I'm like,
and no one's going to stay in that property because the chimney looks nice.
Nobody cares. Yeah, exactly. Yeah. So like when you're in the beginning, you don't know what you don't know.
For sure.
Experience speaks volumes.
Yep. No, that's really solid. I like that point too, because that actually opens up something for me with these people I'm wanting to work with. Is that may be the best route for me to go, is kind of do that joint venture with them and say, hey, I can lend you this money, but I have to take a certain agreed upon percentage in order for us to do this first deal together. Hopefully it goes great. So then your next 2, 3, 4, 5, 6 deals, I'm your lender. I'll take care of you. I know how you guys operate. I know it works well. We work well together. Communication's good. Boom. So yeah, I like that idea a lot.
The other thing that I would say too is rather than like, I would put a defined dollar amount in your paperwork rather than saying we'll split profits 50-50.
Because if they don't make money,
I'm going to make a minimum $25,000 and then you get whatever's left. And that may be $50,000.
Okay.
But if they botch it, at least you get like a guaranteed amount and it's in contract, it's in writing. So if they lose money on the deal, you still make $25,000.
Very smart. Boom. That's all I got, dude.
They'd be like amazing questions. So like, and I know we said this before, but such like when you've just been in kind of the trenches for so long, you kind of forget what you don't know. So this is so valuable to the audience. So seriously, thank you. This is killer.
No, dude. I mean, I needed this myself because I told you whenever we had this idea for the podcast, I was like, oh, dude, this is brilliant because I'm going through this right now. As although I've done my 3 deals, like they've kind of had my hand held with John. Like I've never done one truly by myself. So I am excited to like kind of see how it goes. And this these questions, like I'm going to share this on my social media and stuff because I know there's people who have asked me about the private lending side. This will be one of those episodes that you want to bookmark. And whenever you're going through the process, you make sure you listen through all this at the same time and that you're dotting your I's and crossing your T's.
Yep, absolutely. And there's the nice thing too is it is once you've done a couple, like you don't even think about it and it's just smooth and it takes like 5 minutes to underwrite a deal and it's just quick and easy. But dude, it's scary. It's nerve wracking. You have a lot of money on the line and there's a lot of moving pieces and a lot of things you have to check and verify and validate. And it is really scary. So you want to make sure that you do it right. Absolutely. So you're asking all the right questions. You're taking all the precautions. Like I know that as you do this more, you'll be very successful. And on top of that, if you decide to jump into it like a little bit more full term, post about it on your social media, and then people will come out of the woodwork with funds. That's all we've done. And people are like, you know what? I am a doctor or a dentist or whatever. I want to get into real estate. I don't know what I'm doing, but I've got $100,000 sitting on the sidelines. Can we work together?
Yeah.
That is a beautiful thing. And then you start making money on other people's money and it scales really quickly.
Sweet. I love it, dude.
I love it. So, all right. Well, I think that's a good place to put a pin in it. So for everybody listening, thank you so much for being here. Of course, this is the Lender podcast. So if you're looking for a private lending piece of software, Lender is the tool to do it. It tracks all of your payoff statements, tracks your investors, interest rates, generates your loan docs for you. It's just a one-stop shop tool for everything. So if you're looking to get into private money, I highly recommend you check out joinlender.com. And JJ, thanks so much for being here. I've really appreciated it.
Let's do it again, dude.
Let's do it. Love it. See you guys.